This is a year where we have so many changes going on in the system that it really helps to get all the advice that you can get. So today's webinar is co-sponsored with the Candy Factory, and the Candy Factory co-sponsors a number of these events with us throughout the year in support of their members as well as SCORE clients. And so it's an effort for us to reach a broad brush of the population and bring these beneficial forums together for many of you. Our speaker today is Susanne Dombrowski, and Susanne Dombrowski is co-owner of Bazella, Dombrowski and Company, a CPA firm here in Lancaster, and they've been in the business of serving businesses in the community since 1996. She's also the CFO of 1234 Microtechnologies and active in many other financial services throughout the community, including being on the advisory board for SCORE Lancaster-Lebanon. So we really appreciate Suzanne's contributions to the success of small business in the community, and particularly to our clients. So without any further ado, I'm going to go over a couple of rules and then turn it over to Susanne. So for today's session, we are going to record it. It will be available to you at the end of the session. We'll send a follow-up note and let you know where the video is. And we can send a copy of the presentation, and any open questions that we are not able to address today, we can follow up with answers on those to all of you that are participating in today's webinar. I would ask that you put your questions in the chat room. If they're relevant to a specific slide, Susanne and I agreed that I'll interject and ask those questions. Otherwise, she's really structured it so we have open time for questions at the end of the presentation. One more thing before I turn it over to Susanne. Anne, thank you for joining us, and I apologize for the connection challenges, but do you have anything you want to say to the group today?
I just want to welcome everyone. Thanks for being here. Thank you for SCORE and for helping coordinate these lunch and learns. We find them incredibly valuable here at the Candy Factory. If you're not familiar with the Candy Factory, we're a co-working space in Lancaster. I'm always happy to answer any questions that you might have about getting out of your home office and how we can be of service. So thank you, Kathy. Appreciate this.
Yeah, we really appreciate the partnership, and both in sponsoring these kind of events, in the work that you do to support small business, and also in your work helping us help clients in the community. So thank you very much for that. Okay, Susanne, I'm gonna mute myself, turn it over to you, and I'll bring up your presentation and let you go ahead and introduce yourself.
Okay, thank you, Kathy. And hello, everyone. Welcome to you all. I know a couple names on the list, but not too many. So nice to meet you all. First, for me, you can see it is a sunny day today, and I have blinds behind me. And so that's the best I can do there. Turn down as hard as I can turn them down. And sometimes you may see I have a little halo, and I think that's okay. I can live with the halo. So we have a lot to cover in a very short period of time. And this is the very first time I'm actually doing a presentation over Zoom. I have done many in-person presentations, many for SCORE. I have participated in many Zoom meetings, as we all have in the last year, out of necessity, but it's the first time I'm presenting, so it's a little unusual for me, if you bear with me. I also want to mention that we're going to go over a lot of legislation because, as you know, there has been quite a flurry of legislation in the last year, much of it necessitated by the pandemic, and much of it changed also through the year. So I'm going to give you, I hope, the best information I can. This is by far the most challenging tax season coming up for me in my entire career because of the deluge of information and changes that are occurring all the time, and so many unsettled issues still remain. And we're going to get a late start because the IRS is not opening e-filing until February 12th. If you haven't heard that, that's their deal. It is open for business filings, but not for individual. So we're going to get a delay. And of course, we'll probably still have to be done by the 15th of April, but who knows, that could change. It certainly did last year, which was the tax season that would never end. And so if I misspeak, which is I have the potential of doing because of all the changes and changes to the changes, I apologize, but I will try to give you the best information I can about where things stand right now. And a lot of what we go over will impact you personally as well as for business. I was trying to really gear this toward a small business tax tips talk, but quite frankly, there's a lot of individual things that I just felt it was necessary to convey to you as well, whether they impact you or a family member. They're all good to know. So I hope you're good on that. We'll start with my first slide, which is the beginning of the legislation, which actually started before we all knew there was a pandemic. So the first piece of legislation that had significant impact was from December of 2019, the Secure Act. And the Secure, I'm hearing something.
Kathy, can you mute everybody?
2020 year. There was not 1 month where we did not have new members being approved by the board of directors.
I have competition.
You do.
And even though the pandemic halted a number of things, it did not stop new businesses opening and expanding in northern Lancaster County.
Kathy, can you hear me?
We also were able to shift.
Kathy, you might
Yes,
want to,
yes, I
Can you
can.
mute everybody?
when
I
I'm
am-
coming from Kathy's computer. So Kathy, you might want to just close a window.
It's not from me.
Yeah, no, but can you mute everybody?
12 specific women in business events.
Okay. And now Suzanne, I need you to unmute yourself.
All righty. Well, that was a good start. Anyway, back to the prior slide, Kathy, with the first one on legislation. Can you back it up one? There we go. So the Secure Act. I have a slide later that I'm going to go over that has a lot of the things that were in the Secure Act. That mostly made sweeping changes to things related to retirement. So we'll go over that in a little bit. The first really coronavirus related piece of legislation was in March of 2020. 2020 felt like a very long year, so it wasn't all that long ago, wasn't even a year ago, but the Family's First Coronavirus Response Act. And that basically dealt with tax credits for sick leave and family medical leave associated with people who were off work to care for a loved one or for themselves being sick, and the employer's response to that for tax credit purposes. It also covered the COVID-19 testing to require insurers to pay for all of that. So then we had the sweeping CARES Act, which is the one that is most prominent in everyone's mind, which was also in late March of 2020. And that was the Coronavirus Aid, Relief, and Economic Security Act. That was the one that gave us the $1,200 per person recovery rebate, the economic impact payment, the stimulus payment. It has a lot of names, but $1,200 is the thing that sticks out for everyone. Not everybody got it, but a lot of the population did receive it. It also included the Paycheck Protection Act program, the PPP. And I know SCORE has done just stellar work with helping people get their PPP money in the last year and keep them informed, keep them moving forward on it, and continues to provide that service now. And that is so valuable because, quite frankly, when they came out with this legislation and they extended our tax due date, we did nothing but help people with PPP from then until June, basically. So it kind of took over our world and made us then have our tax crunch for July 15th. So that was a sweeping program. I could spend a whole hour on that. I'm not going to. So you may have questions on it, especially since it has been repopulated for PPP round 2. But I'm not going to spend a great deal of time on it. If you have individual questions, maybe we can do them later, or you can put them in the chat if you think they're a quick, easy answer. It also brought us the economic industry disaster loans, the EIDL loans. Many people got those. They were grants from the SBA. I'm sure SCORE was involved in helping people with that as well, because it was kind of a companion there at the same time with the PPP. There were payroll tax deferrals that some businesses did. I didn't see too much of that. The federal government actually mandated it. So there were people that definitely had their payroll tax deferred. However, it was a deferral, so it will be due this year, actually. The PUA, the Pandemic Unemployment Assistance, the additional $600 that many people received in addition to their state-funded unemployment, came in with the CARES Act. The Employee Retention Credit was created with the CARES Act in March. It has been further strengthened with the next legislation I'll talk about, and made a little more relevant. So I'll go over a little bit of that just so you know that exists. There were retirement fund rules relaxation, which I'm going to go over in a bit. There are now net operating loss carrybacks that had kind of gotten suspended with the Tax Cuts and Jobs Act from 2017, but they're back. So we'll talk about that a little bit. Next slide, please, Kathy. The final major piece of legislation in 2020 was in December, the Consolidated Appropriations Act. That actually was the piece that we were waiting for, so much so because PPP funds, for most of last year, it was said that any expenses for your business that you paid for with PPP funds that would be forgiven, you would not be allowed those deductions on your tax return. And this particular act in December said, oh no, you will be allowed those deductions. So you get the PPP money, you don't have to call it income, and the deductions are allowed. So huge change. Everybody was waiting for that. It also ushered in the second round of PPP funding, which is currently open for people to apply for. A second draw, if you will. So that was noteworthy because the pandemic is still marching on and businesses are still suffering in a major way, depending on your sector of the economy. It also brought us an additional $600 recovery rebate stimulus payment. Those checks are going out now. The deposits are happening. What I hear is that anybody that got the first one should certainly be getting the second one. There was an extension and an expansion of the employee retention credit. And the importance here is that many people didn't pay attention to the employee retention credit, which was meant to provide a tax credit for employers that kept their people on, even though their people weren't working, but they paid them. Originally, the PPP money, if you used it for payroll, you couldn't take the employee retention credit. But they have changed that. So if you have not yet applied, and I hope you haven't applied for forgiveness yet, because we have been cautioning everybody to delay applying for forgiveness because they kept changing the application process so many times. You can actually go back to last year and get the employee retention credit for employees that you may have kept that were not working, but you were paying them. There's a lot of rules around that. You can take that credit, but you can't use that same payroll to get the forgiveness for the PPP. So it's available now. One doesn't cancel out the other, but you can't use the same wages for both. So there's a lot of material around that. It does go into and becomes more generous in 2021. So that is really important for businesses that are still not able to bring all their employees in or were shut down a second time. There was an extension in this December 2020 legislation of many tax provisions that were expiring. They've brought them back to life. And also tax credits like the work opportunity tax credit. There was a lot of housekeeping done by this bill to allow expiring provisions to continue on for 2020 and into 2021. So a lot of detail there. Also, there was an extension of the Paid Sick and Family Leave Act, the very first act from last March. And that goes now through March 31st of this year. And what I want to point out is that includes the self-employed. So for example, if you are self-employed and unable to work because you're caring for either yourself or a family member, then you can actually get tax credits, payroll tax credits, even though if you're self-employed and have no payroll, you can still get these credits against your self-employment tax. So that's a big deal too. Here's a big one. 100% of business meals will be allowed to be expensed for 2021 and 2022. I've never seen that before in my career. Federal deductions for business meals have always been 50%, and they will be 100% this year and next year. Where that came from, I'm not sure. I guess it was a little tip of the hat to the restaurants, which, believe me, they need it. So I think it's great. And then if any of you or any of your family members are participating in flexible spending accounts, it was very difficult last year for people to, that's the use it or lose it pre-tax health, related things, money that you set aside, or for daycare, for example. There was always a big push at the end of the year that, use it or lose it. You got to spend your FSA money. Well, they have allowed those to be carried over. The unused balances could be carried over. I wish they would have announced that a little earlier in the year. It would have helped people a lot, but you should know that that does exist. So that's that for the rundown of legislation. It's an awful lot of things. So next slide, please, Kathy. So let's talk about those recovery rebates, the stimulus check. I want you to understand what's going to happen with that, because the only thing the IRS had to go on to issue that money was, in many cases, 2018 or 2019 tax filings. So they would look at your income reported either in 2018 or 2019 and decide whether your income was of the place where you were qualified to receive the $1,200 per taxpayer and $500 per dependent child under 17. There was an income phase out rule. So if you were single, you started the phase out after 75,000 up to 99,000, and joint filers 150 to 198. So what will happen to that if you in 2020 didn't make as much money and were qualified, but in a prior year you were unqualified because you made too much money? This will all be reconciled when your 2020 tax return is filed, okay? Along with the second round that came at the end of the year, the 600 per qualifying taxpayer and child. And that just worthy of note, the 600 is per taxpayer and per child under 17. So they didn't have, you know, how it was 1,200 per taxpayer and then 500 per child. It was 600 across the board for the second round. All of that will be reconciled on your 2020 return. Underpayments, if you did not get it the first time, but you are qualified by your 2020 income, you will get a refundable tax credit. So it'll either be applied toward the tax you owe, or if it's more than that, you'll get the cash back. Overpayments are generally not going to be paid back. However, there were cases where people who were alive in 2018, but then deceased after that, received the 1,200. Those were supposed to be returned to the IRS. Those payments, the 1,200, the 600, are not taxable income. So they will not impact your tax return in a negative way. Unemployment, however, is taxable. So remember that, because if you got a lot of unemployment, including the 600, and you didn't have a lot of withholding on it, you may have a surprise when you're doing your 2020 return. Next slide, please, Kathy. Retirement plans, IRAs, lots and lots and lots of activity for this. Mostly in the Secure Act, the first one I talked about, that was at the end before we knew about a pandemic, but some of it was in the later legislation. So I'll go over these real quick. This is the highlights of what's going on here. So the beginning age for required minimum distributions, or RMDs, moved from 70 and a half to 72. So that started in 2020. Also in 2020, because of the pandemic, the required minimum distribution requirement was waived. So people were actually able, if they had already started receiving it and they decided they didn't want to, they could actually put it back. They had a certain period of time to do that. So there was a lot of activity last year among required minimum distributions. So people that didn't need to, the theory behind it was, when the stock market took such a huge hit in March and April, they didn't want people to be forced to be removing their retirement savings at such a low rate. So they waived it for the whole year. It is not waived for 2021 at this point in time. And the market is high, so I don't anticipate they will either. Another big change is that individuals that are over 70 and a half and are still working, having qualifying earned income, can now continue to make contributions to an IRA if they so choose. It used to be that once you were 70 and a half and required to do your RMDs, even if you were still earning, making a paycheck or self-employed, you could not put money in them, but now you can. A negative through this legislation, most of the IRA related and retirement plan related legislation was very positive for individuals and for businesses. However, the one that people consider a bit of a negative is that it used to be that if you inherited an IRA as the beneficiary, you could create an account and spread your withdrawals from that IRA over your lifespan. which was a very good estate planning tool. Now, most inherited IRAs in 2020 or later must be fully distributed within 10 years. Doesn't have to be evenly distributed within the 10 years. You can do it any way you want, but within 10 years, it needs to be distributed out. And that's for non-spouse beneficiaries. Spouses still have the right to make the IRA their own and do it over their lifetime. So there were changes last year for due to coronavirus with retirement plan distributions if you are under 59 and a half. So if things got so bad that you had to take money out of your IRA or retirement plan like 401k, normally a pre-age 59 and a half distribution would, with no other, there were always some like disability qualifiers, etc. But typically you would pay a penalty if you didn't have one of the good reasons for having taken it out. Now for last year, there is no 10% penalty on up to 100,000 of distribution from a 401k. You can also include that income in equal installments over 3 years. So if you had to take money out, you won't have to, and you're under 59 and a half, you won't pay the 10% penalty. You can include it in your income over the next 3 tax reporting years, 2020, 21, 22. You can also, if you don't really want to have to pay tax on it and you think eventually you can repay it because you want to get yourself back to where you were, you didn't really want to take the money out, you can repay the distribution. You have 3 years to do that. If you have already paid the tax on it and you decide in a subsequent year that you now have the money that you really want to put it back, you can put it back and then you can file an amended return to get the tax money back. You know what's difficult about doing the Zoom meetings? You're not looking at faces, so you're not sure whether people are comprehending everything you're saying. I don't like that part of it. Anyway, so I'm just going to keep talking. If you have questions, put them in the chat. Oh, thank you, Lisa. Lisa says this is helpful. Good. There's just so much to know. There is a new there has always been a small business tax credit. It was small, like I think $500 if I'm recalling correctly. So many numbers swim and live in my head that, you know, you get them mixed up. But there was a small business credit to cover startup costs for starting a retirement plan. So small business owners should know that. It can be, if you're going the 401k route, it can be expensive to get it set up. The costs for that, the small business credit has been increased to $5,000. So whatever you have spent up to $5,000, you get a small business tax credit for starting that 401k, which is really a good news item. Also, beginning 2021, unrelated small employers can participate in a multi-employer retirement plan. That's big because many small businesses do not have 401ks because they're expensive. So you need to have a lot of employees to justify the cost of having a 401k. So many opt for doing the simple IRA, which is fine too, but your employees can't put as much in a simple IRA as you can in a 401k. So this is a really good thing. It will be, those multi-employer plans will be administered by a pooled, in a pool sense by an administrator. Also, there are new life expectancy tables for required minimum distributions that will begin for the 2021 withdrawals. So anybody that is taking RMDs, there's a new table. It stretches lifespans out a little further, so the required distribution will be less by the new tables, and it will be in effect for distributions starting next year. Okay, that's it for retirement plans. This is just kind of posting the numbers for all of you to see for the standard deductions for 2020. As I'm sure you all know, you either get a standard deduction when you file your taxes or you itemize your deductions. That was increased starting in 2028 to be a pretty large number for the standard deduction compared to where it used to be. So many people now file using the standard deduction. So I wanted to give you these numbers for 2020 purposes, because if you're assembling all of your information and you're married and all of your itemized things don't come over 24/8, then stop assembling them because you don't need them because you're going to do the standard deduction. So married 24/8, single 12/4, head of household 18,650. If you are over 65 or blind, each married person in the married couple gets 1,300 apiece. And for singles over 65 or blind, it's an additional 1,650. So those are your standard deduction markers for the year. Thought they would be helpful for you. Next slide, capital gains. Okay, little information about capital gains, just so you know the thresholds. The rates are the same, 0, 15, and 20, and this is capital gains and qualified dividends. The income thresholds for those, as those rates change, have changed for 2020. So the 0 capital gains or tax on qualified dividends is for single filers with taxable income of 40,000, head of household 53,600, and for joint returns 80,000. So if you have capital gains from your taxable accounts and your taxable income, which is your income after itemized deductions or standard deduction, is 80,000 or less, you will not be paying capital gains tax on those dividends or capital gains. The 20% rate, so most capital gains are taxed at 15, but the 20% higher rate kicks in at very high thresholds, and there you see them, little over 441,000 for singles, 469 for head of household, and 496,601 for joint returns. So they're pretty high thresholds. There's definitely a marriage penalty built in there, which is still exists, because if you have two single people living together, they have a much higher threshold together than joint return. Anyway, that's just an aside in the tax world. Charity, a couple of things to mention here. There is something new for 2020 that was in all of this flurry of legislation. If you file using the standard deduction, you may still deduct what they call above the line, so on the front of your tax return, before adjusted gross income, $300 per return for cash donations. So that is only available if you are a non-itemizer. So if you're not itemizing, your tax preparer will still need to know if you gave at least $300 in cash donations. This does not include clothing to Goodwill. It has to be money, and you do need to have a receipt. So that's something brand new. The 60% of adjusted gross income limitation for cash donations is suspended for 2020. So if somebody wanted to give 100% of their income away, they would get to deduct as an itemized deduction 100%. This excludes giving gifts to donor advised funds or to private non-operating foundations. And I just threw in the suggestion that because the itemized is so high, many clients, and I recommend this often, who are kind of close with their charity to itemizing or non-itemizing, I recommend that they bunch their charity between years. So you can itemize in alternating years. You know, 1 year, for example, you can do a lot of, especially in a fiscal year organization, you can donate in January and then donate in December of the same year. And you've increased your itemized deductions and you'll itemize that year. And then the next year, you're not given to either of them because you kind of already gave twice, and file the standard deduction. You may work out better that way between the 2 years. So just throwing that out as a tidbit. And next one, Kathy.
Suzanne, before I switch the page,
Sure.
a comment came in and they're asking, they were hoping to gain information about quarterly filing for a new small business. Are you going to be addressing that point here as we go forward through these slides, or can we address it at the end? What are your thoughts on that?
Estimated tax payments or quarterly payroll would be my question.
Unless the person wants to ask the question directly, they're asking about information about quarterly filing for a new small business.
Okay. I'm assuming that they're concerned about income taxes and the need for like a sole proprietor to make estimated payments. We can, I don't have a slide specifically on that, but if you make a note of that, or I will, we'll talk about the estimated payment rules at the end.
Okay.
Okay.
And then one question is the $300 above the line donation deduction for 2021 too?
I believe the answer is yes.
Okay.
But I'm saying that with a little hesitancy because, as you know, all these things are still swimming around in their head. It's definitely for 2020. I believe it is also for 2021. And I think that came in the December legislation. But my caveat is I might be misremembering.
Well, we have the question in so we can send it out with the notes afterwards.
Sure. Yep.
Okay. All right. So hopefully I answered those questions, and I'm moving you on, Suzanne.
Okay, great. Okay, this I actually did mention earlier, but I wanted to kind of circle back around to it because a lot of people don't know that the self-employed people can actually get tax credits against their self-employment tax if they qualify for all the reasons for that very first legislation, the sick and family leave legislation. So you have that available to you as if you were an employee. And then, of course, employers are eligible for those credits as well. This is an ongoing thing because people are still getting sick, and employers have this available to them to help with the cost of keeping those people on the payroll while they're on their leave. So it's an important item, especially how long this pandemic is going on. So I didn't want to give that a short account. I wanted people to know that that exists and be definitely looking into more of it. Okay, so now I'm kind of focusing more on things impacting for the small business oriented, which is kind of really where I started. And then I thought I got muted somehow. So I'm not sure, but I'm going to start over. So this is our small business discussion now. We're getting into more specifically what's available for small businesses. I wanted to highlight some things that are still around that you need to be aware of, such as bonus depreciation is still in play at 100%. This is for new or used items placed in service. It is actually, you have to opt out of it. So bonus depreciation is taken automatically unless you opt out of it. Section 179 is that expensing election, which people think of the same as bonus depreciation. It is not. They are two separate things, but you could choose one or the other for your purchases, for large equipment purchases, for example. The maximum deduction on that is $1,040,000. So people say, well, how do you decide what to take? Bonus depreciation can put you into a loss position, potentially. Section 179 cannot. So that's why there's a little interplay between the two that should be discussed with your tax advisor. The mileage rate for 2020 business driving, as you're putting your mileage logs together, because I know you all have mileage logs, is 57.5 cents for last year. For 2021, it actually went down to 56 cents. Qualified business income, QBI deduction, is still around for sole proprietors, for pass-through entities, S-corps, partnerships. It is a deduction from of 20% of your net income from your business. This was new with the Tax Cuts and Jobs Act and remains in play. They did, however, move out the phase out thresholds. So you may recall that certain businesses, like accountants and attorneys, specified service businesses, they cannot have this QBI. It phases if their income is at a certain level. So there you see on the slide the phase outs for people married filing joint. The phase out begins at 326.6 of adjusted gross income and goes away completely at 426.6. And again, this is just for specified service businesses. For all other types of filers, single, head of household, filing separate, 163.3 to 213.3. That's the phase out thresholds for not being able to take the QBI deduction. That has been, over the last couple of years, a very, very valuable deduction for small business. I mentioned earlier, and I'm going to reiterate, that net operating loss carrybacks have returned for 2020, and they actually can be retroactively applied. The Tax Cuts and Jobs Act said you can't carry back net operating losses anymore. You have to carry them forward. So some of you, if you started up your business in the last couple of years, may have carry forward amounts. The net operating loss carrybacks have now been reinstated. And if you had one in 2018 or 2019, you can actually go back. There are procedures for doing so. And these carrybacks are mandatory unless you opt out of them. So this is a whole area of examination that is going to make tax season very interesting this year, because there are so many things to think of that can be potentially retroactively applied and beneficial. So let's say that you had a loss in 2019 and your 2017 year return was a big year, a big income year. You can go back and get tax money back. So very, very valuable and something that needs to be looked at. I wanted to talk a little bit about the home office deduction for my, I feel at a loss to not know whether the people that are in this room with me are just starting up and are thirsty for all brand new information or know a lot of things already. So the home office deduction is something that is definitely available to small businesses, was before, continues to be. It is very important for small businesses to take the home office deduction if your office is in your home. The temporarily working from your home, and this may affect other of your family members or you, if you're, because of the pandemic, you're temporarily working from home, but you don't normally work at home, you can't take the home office. It is really for the self-employed, and it is used to offset as a business expense for them for having their office in their home. Temporarily working from home will not qualify. I also wanted to mention independent contractors. Again, I usually like to bring this up for the small business discussion because many small businesses start up and do not have payroll right away and then actually need to pay people to help them, and when does an employee become an employee and not an independent contractor. The IRS is starting to put increased scrutiny on this. They have revised their kind of checklist of rules to decide whether it's an independent contractor or whether it's an employee and should be put on payroll. So you want to be very, very careful here. If it is truly an independent contractor, they have a lot of say in what they're doing and whether they come to work for you or not. If the more you have to say about them, the more they look like an employee for you. So it's a real control thing and rule thing. So be very careful. If it is truly an independent contractor, right now you should be giving them a 1099 for if you paid them more than $600 last year. There is a new 1099-NEC form that is new for this year. That is for your independent contractors that will have to report that themselves as self-employment income. The 1099 miscellaneous form where you used to put that information is now pretty much just reserved for rents and royalties and other things, payments to attorneys. There still is a 1099 miscellaneous, but if it's an independent contractor that you're paying non-employee compensation to, that should be the form 1099-NEC. So those are some small business things. I also wanted to mention the things that the IRS is obviously emphasizing this year for tax preparation purposes. Cryptocurrency, the Bitcoin type things, increased emphasis on that this year. They've moved it to page 1. It is a separate question. At any time during 2020, did you receive, sell, send, exchange, or otherwise acquire any financial interest in any virtual currency? There are very few reporting requirements on cryptocurrency. It is considered like a security in terms of taxability. So if you cash in some cryptocurrency to pay for something, if you're exchanging it in any way, it is a capital gains type of transaction, and it needs to be reported on your tax return. But you're not going to get a 1099 for it. So it is up to you to be reporting it, and this is a question on every return. Also, they have been and continue to increase emphasis on financial asset reporting. So when any foreign bank account you may have totals $10,000 or more at any time during last year, you have to report it. You're not going to pay tax on the asset balance. You are just reporting that it exists. But if it is an interest-bearing type of account in another country, in another currency, that still needs to go on your tax return. If it's interest income, it goes with all of your other interest income, etc. So that is something also that, you know, they're looking at more and more and more, and really trying to, it is your obligation to file that with your tax return. And it's very important that you don't forget about it. The world is getting smaller all the time in terms of people moving around and ending up having assets, maybe even inherited assets from a family member in a foreign country. So it is something to keep in the back of your mind. Here's just something else I threw in there because I think it's interesting and not everybody knows it. If you have a 529 plan for someone, you're now able to use up to $10,000 per year of those funds to pay down student debt for yourself, for your children, for your grandchildren. So it is something that you couldn't do before. It had to be for tuition and fees and that sort of thing. And now they've broadened that up to try to help with the big looming student loan debt crisis that we have in the country. So I see a number of things. I see there's 12 things in the chat. So there must be some questions, I take it.
Yeah, so first let me say that I think, Suzanne, this has been a lot of information for many to digest. So I
Yes.
want to reassure everybody that we will send you the presentation and the video recording of today's session so that you can review it later. And I think it's all important information for you to be aware of as you talk with your accountants and tax preparers, so that these are questions that you ask. Suzanne, I'll kind of let you take it from there and we'll see what other questions come in.
Okay. Is there anything remaining in the chat that we need to address? I want to talk about estimated payments, I think.
Yep. And then one question is, I heard you can deduct $15,000 for a PA 529. Can you go over that point again?
Yes. 15,000 you can certainly go that high, or any amount that you would donate to a 529 plan. Any 529 plan, doesn't just have to be Pennsylvania's, is tax deductible for Pennsylvania tax purposes, not for federal, but for PA. So yes, you can do that. You have been able to do that in the past, and that remains a valid provision.
Another area of question is the QBI after estimated payments. Can you touch on that a little bit more?
Sure, I will. So let me do the estimated payment question first, and I hope that whoever asked that, I'm getting to the right thing here.
First, explain what it is.
Yes. So if you are self-employed and are profitable, hopefully, you have to pay tax on that money that you've earned from your endeavor. But you're not on payroll, because if you're a sole proprietor, you don't pay yourself a paycheck. So you don't have any withholding. So how does the tax money get there? And of course, the self-employed pays not only income tax on their net profit, but they also pay self-employment tax, which is 15.3%. So the self-employed people that do not have other ways of having federal withholding tax or state withholding tax are required to make quarterly payments to the IRS, to Pennsylvania, sometimes to the local if your income is large enough. And those quarterly payments have funny dates because they're not exactly quarterly. So the first one is due April 15th. The second one is due June 15th. The third one is due September 15th. And the very last one is due January 15th. So usually you can kind of wrap up your year for that very last one, and you have a little extra time to make the payment, because you'll see, these are estimated payments. So it's real hard to know in April exactly how much money you're going to make. So sometimes they fall short, and you want to make that up in your December payment, or your January payment, excuse me. So that's how the quarterlies go. They then get reconciled the following year when you're filing your tax return. Those are in there and credited to you, and it all gets reconciled how you did with your estimate. Whether you were high or low, you're either going to be under or overpaid. But it is a requirement. There are penalties for not doing it, because the taxing authorities do want to have the tax money kind of proportional to how you're earning it. There are also some thresholds for having enough paid in based on your prior year. There are rules about that to avoid the penalty. And I can go over those with you if you like as well, but that's a little detailed. So if anybody wants to just say, yes, I need more. Oh, I just saw, what is the penalty? The penalty amounts are calculated differently every year. There's a percentage on the underpayment. So it'll be a calculation based on a certain percentage rate. I think it's currently around 4%. The IRS states the penalty rates. But there are also what they call safe harbors. So if you get to a certain threshold and you know you're going to owe more, but you're at that safe harbor level and you've paid in according to that, then you will not have any penalties and you can wait and pay on April 15th with your tax return.
Suzanne, another question here is, had this person had taxes deducted from their base unemployment, but not the extra $600. What percentage will that $600 be taxed so they can prepare for their taxes?
Okay, that will be taxed at whatever tax bracket you land in. So, and I also will caution that often unemployment withholds 10%. So if you're in the 22 bracket, that will not be enough for you. So you will still owe tax even on the state unemployment that you received. So it really goes back to being reconciled. You know, let's face it, your tax return is a reconciliation report. You're reporting all your income and you're accounting for whatever you've paid in, and then you're either ahead of the game or behind the game. And but the 600 is going to catch a lot of people, I think, this year that will end up owing because of the extra 600 per week. So whatever your tax bracket is projected to be, that's the tax rate that you will owe on that 600. It is not taxed for state purposes, however, only federal.
So Suzanne, another question is that this person heard from someone that purchases and deductions for 2020 could be made up to January 31st, 21 instead of December 31st, 2020. Is that the case?
I have not heard that.
Okay.
That's interesting. I would love to know where they heard that from. Has anyone else heard that? That's a new one. I've never seen that done before, but you know, there's a lot of unusual things this year.
Well, if we find out something about it, maybe we include that with the notes, but right now we're not aware.
We'll spread the word. That would be very interesting to know.
Can you go over the really important point again on how we can get money back from taxes paid in 2019 for small businesses?
Regarding the net operating loss, is that the question?
Jeremy, I'm going to need some more definition from you.
Sure, no problem. I'm just going to unmute myself and ask.
Thank you.
First,
Sure.
Suzanne, great meeting. You're doing great for your first time.
Oh, thank you.
I was writing things down, and I don't know how to answer that question. You had a slide, and you said, "Hey, this is a really important thing." And then my eyes went up, and then we kind of moved on to the next thing. So I should have been paying attention, and I wasn't. And I'm wondering if you could go over that point again.
Okay, I think it might have been Jeremy when I was talking about net operating losses. So if, for example, someone had a loss in their 2019 tax year on their small business, the rules at the time said you have to take that loss and carry it forward to another year and get the offset in a future year. And the change in the rule is that you now can carry that back. So even though it was from 2019, it's not just 2020 losses that can get carried back, it's also 2018 and 19 losses that can be carried back. There are particular rules about how to do it. There are forms to be filled out to do it. But if, for example, you carry a loss from 2019 back to a prior year when even we paid higher rates of tax, because 17 and older, we were in a whole different tax realm, paying much higher income tax rates. So you could potentially get money back for one of those prior years by taking that net operating loss from 2019 and carrying it back.
Okay,
so it's a whole new opportunity that's available that was not available before.
All about trying to get some money back. Thank you.
It is, especially in this year we've had. You had another question, Kathy, about QBI, I think. Was there one?
I think we covered it. There's another one that came in that said, I received our PPP, 4,950 before unemployment kicked in. Then months later, we received our unemployment in a lump sum. What are the repercussions of this?
Oh, well, that's interesting. And I can see how that could happen too, because it took so long for the self-employed to get their unemployment. The worst case scenario you're faced with is that the PPP money is actually a loan, okay? So, which is not a bad thing because it's a 1% loan. So everybody loves financing like that. So that's your worst case scenario. There will have to be some sort of an analysis done on that to see whether you're entitled to forgiveness for the PPP loan. But you already have it. So if it's not forgiven, it's a loan. So it's not like you're going to have to give it back. It's just, you're just going to have to see what all of your expenses were and your unemployment, and see if there's any opportunity for forgiveness on the money.
Another question is, do we have to pay tax on unsold inventory in PA?
No, you do not.
Okay. Then Carly is asking if we can go back. She said that you covered quarterly taxes, but you didn't fully cover QBI. So maybe one more time around QBI.
QBI, okay. Qualified business income deduction is available for sole proprietors, partners in a partnership, S corporations. Those are what are considered flow-through entities. It represents, with certain modifications, there's formulas for these things, but so there are limitations on it. But essentially where you start is 20% of your net income from your business is a deduction from all of your income, all of your other income. And then, of course, you have to look at, there are wage limitations, there are income limitations, and but it is a very, very valuable deduction to the self-employed, and you want to be sure to be taking advantage of it. It has been around for a couple of years now, so people are getting used to it, but it didn't go away. It still exists, and it's very valuable. So I'm just cautioning you that you want to make sure you get that.
Great. It worked. That was a good explanation, she said.
Okay, good.
All right. Any other questions? Do you want to go back to that one that we held from earlier?
Which one did we hold? The estimated tax we were holding and
Yeah.
the QBI.
Yeah,
Was there another one?
the estimated tax one, I think, is the only one we have.
Yep, that one I did. The quarterly, estimated quarterly taxes.
Okay.
I did that.
Okay. I think we've answered them all. If anyone has a question that we didn't cover through the chat, please unmute yourself and ask the question.
Yes, please do.
Anybody?
Thanks, Suzanne. Appreciate it.
You're welcome, Jerry.
You know what, Suzanne, one quick question. I mean, you know, I guess I could, since you're here, we received a lot of grants this year. Are those, like, other than PPP, are those grants taxable as well?
It depends. This is the typical tax answer. It depends on the grant. Many are taxable and some are not. And some are taxable for federal and not for state, or vice versa. More likely vice versa. The state is taxing a lot of it. The state is taxing the PPP money. So, and it's still the Wild West about that, because believe me, every day I get new guidance. I should have retired last year. My life would be simpler if I had, but I didn't. Because there's just so much changing, and I feel like I'm, drinking from a fire hose about all the information. And the danger is you can look things up on the internet and you will find the old information. And so how do you know that whatever you're reading has been revised? That's the real danger. I feel that from where I sit, I feel like I might be reading old stuff. I'm constantly searching out new sources. It's going to be a difficult time this year. So the question about the grants, some of them are taxable. Many of them are not. Some are taxable to for-profit businesses and not for-profit businesses, unless the grant was for something that the not-for-profit business uses for an unrelated business thing. So it's very complicated, to say the least. And I learn something every day, which I do love, because a day without learning something is just not as good as a day where you do learn something. So that's kind of one of my mottos. So I love learning new things, but boy, oh boy, this has been a challenge.
Susanne, can you put your email address in the chat room? And
Sure.
there was a request for that. And are you willing to do this again? It sounds like there's a lot of interest in this, and people would like us to do it again.
Sure. Like with more specific information, or just the exact same thing again? I'm happy to do it a second time because I already prepared it.
Well, let me see what feedback I get after the meeting, and if we need to add a couple things into it, we can. Otherwise, I think it can just be reaching out for more people, since there is so much tax change that people can really benefit from this.
It is, I can't say it enough, unprecedented how much changed. There was so much rolled out so quickly without forethought. Mm-hmm. For example, the employee retention credit, this is a gold mine for employers. But we're still waiting on, now that we can go back into 2020 and apply for it, what do you do? How do you do that? We're still waiting for that from the IRS, Yeah. And because so much was changed, and they've been, as many of you know, they have been so delayed by the pandemic. And so they, even just getting information out to us and decisions about how things are handled is difficult for them. So stay tuned. There's going to be a lot more change.
One other question in here was, does money to a church count as charity?
Yes, indeed, it does.
Okay. Well, I think we've had a full session, lots to absorb. To make it as easy as we can on all of you, as I said before, we will send the presentation and a link to the recording following today's webinar to everyone that was here. And if there are any issues that come up, we'll make sure that we include those as comments in the notes that we send out. So we thank you all for being here. Based on the questions and comments, I believe this was incredibly valuable for everyone. So take care all.
Thank you. I love doing it, and good luck to everyone. Stay safe and make money.
Thank you.
You're welcome.